Welcome to TheoTrade. This is Don Kaufman. You are watching the Theo Weekend Update for May 19th, 2018. All right, let's get started. A quick week in review, and we're going to look forward at a couple of opportunities we see as kind of up and coming here. Let's start with the idea that, volatility inside of the S&P 500 died out as the week kind of progressed. You know, a lot of intraday traders just kind of, volatility died. Here we are again. We're in a 13 VIX. But there's a bigger picture really going on inside of today's marketplace, and it has everything to do with the bond market. So bonds actually saw quite an uptick in volatility this week. And this is not necessarily like, okay, if you're trading S&Ps or if you're trading Nasdaq on an intraday basis, you need to shift over to the bonds. Not necessarily. Okay. But what I am saying is that with bond volatility upticking, you can expect some more volatility to hit the S&Ps in just the next couple of weeks. Now, granted, we're going to be coming into a holiday, right? We're going to be coming into the holiday. It's the end of May, a lot of vacations out there. So you wouldn't necessarily expect volatility, okay, coming into this next week. However, early in the week, the S&Ps are pricing a bit more volatility. In fact, we'll discuss a little bit about that. So back to the bigger picture over here, it's all about bonds, it's all about interest rates. So the interest rate on the 10-year jumps above the 3%, even hits 3.1%. And everyone is kind of looking around the marketplace thinking to themselves, all right, yeah, but we're going to learn to live in a higher interest rate environment. And that's not necessarily the argument that I would make when I say we'll learn to live. Yeah, us, on the retail side of this business, so we've got to deal with higher margin that you have to pay. If you use a margin account and you do borrow capital, you're going to see your margin interest rate start to increase. If you have a credit card, you have credit card debt, obviously you're going to see some of the credit card debt start to go up. But that is not my argument for higher interest rates being problematic for the markets. And, I've talked about this in weeks past, but it seems, again, this stuff kind of gets thrown by the wayside. One of the things you really want to think about with higher interest rates has everything to do with what is termed the cost of carry. Now, cost of carry may not necessarily impact you or me all that much on the retail side, but in the institutional trade and what they term like, arbitrageurs and arbitrage and statistical arbitrage, huge genre of trading, the cost of carry is increasing substantially. And why do I mention this? Because if you look at a marketplace and you look at some institution, now an institution can be a hedge fund, it can be a bank, it could be a proprietary trading firm. I mean, we could talk about different institutions to kind of, we're blue in the face. But the point is that many of these firms, they use algorithms to trade. And many of these firms are using these algos to try to capture fractions of a penny, literally thousandths of a penny, and do it tens of millions of times within a given period of day or the given week. Well, as the interest rates start to climb, right, there at some point is an inflection where it's no longer even viable to do certain strategies. So what do they effectively do? All right, well, the cost of carry is too high. That means the cost of doing that particular strategy, the juice is not worth the squeeze anymore. So what do? They kind of retract some of that strategy. And one of the things that a lot of people are talking about in markets lately is they've seen liquidity start to die down. Yeah, that's because the statistical arbitrageurs, they're not necessarily there doing some of the same strategies. So we're seeing some of the liquidity of the market. So this is just the beginning of what we're seeing, again, in higher interest rates. It's not exactly, again, a wonderful environment on the institutional side, but it will be. Why? Because as those interest rates start to climb and as that cost of carry starts to go up, again, these firms will move away from certain trading strategies, and therein lies an issue, right? Less liquidity in the market, yes, but that's when volatility, will start to rear its ugly head again as liquidity kind of withdraws. Then the trading firms come in, and then they'll trade the higher volatility. So for trading firms, it's all kind of big catch-22. They're going to be happy regardless, even if the cost of carry starts to go up. Who gets beaten up in this entire scenario happens to be, mom and pop retail investors, where ultimately they're not going to be able to function as effectively in the midst of some volatility. So the reason I'm talking about bonds and talking about interest rates is, as interest rates climb, Any way you want to put it, it creates more volatility back to the S&P. And just because we saw, a week or two, a little bit of a lull in volatility, people, do not get off your game. One of the things I'm going to show in just a minute here is in the charts, we're going to look at the XLF, it's the financials, and you're actually going to see there's higher volatility right now in the financials than there is inside of the entire Nasdaq. Another thing you can do when the marketplace has a little bit of a lull in terms of this volatility, this is a good time to kind of reload hedges, right? Position yourself for the next move and positioning yourself kind of, revamping some of your positions, being comfortable with your risk. And again, in this lower volatility period, that's when you need to take that kind of time. You need to rest. You need to figure out exactly what you're going to do. You need to look at the pieces of the puzzle 4 or 5 moves into the future. Okay? It is the prime time. Kind of reload hedges, reload positions, get ready for the next bout of volatility. Let me show you a little bit more right now here in the charts. To the charts we go. Let's start with a look at the S&P futures. Now, again, I want to reiterate this point that, you don't necessarily have to trade futures, but everybody, if you're involved in markets, I don't care whether you're in energy stocks, you're trading some Costco, you own some Walmart, it doesn't matter what product, okay? You need to be aware of key levels inside of S&P futures. And the reason is the S&P futures, they drive order flow to the marketplace. And that effectively means where these S&P futures go, so goes the marketplace. All right, zooming in real tight over here. As I said, some of the volatility as the week progressed kind of died out. But, okay, we want to reiterate also the point, don't put away your volatility hats just yet. Okay, this is very, very normal kind of digesting given moves. One of the key levels inside of the S&Ps that you want to look for right here, right now, has everything to do with the 2731 level. Okay, this appears to be one of our kind of definitive gravity points in the marketplace, and we've held under it. Now, if we get above the 2731, do we have some room to run to the upside? Absolutely. However, even though I'm in here and I'm stating like, could the markets trade a little bit higher? Absolutely. But this doesn't change our overall conjecture on the marketplace. And that is what? Okay. Well, we know that we're in a rising interest rate environment. We know that the bonds are going to continue, okay, to drive fear and drive interest rates ultimately higher. And the marketplace will see bouts of volatility in the midst of higher rates. So with that, listen, you got to look at the marketplace right now in this lull. As I was saying a bit earlier on that video, it's a time to kind of reload a couple of hedges, get comfortable with positions. Nevertheless, if we were to trade a bit higher from this, like how is it any different than what we saw again kind of in mid-March? How is it any different than what we saw kind of in late February? Again, these lulls in the midst of heavier bouts of volatility. Again, remember this 2731 handle because I think it's going to come into play in a big way once again earlier in this coming trading week. Again, very likely to touch back up to the 2731, and we'll make that kind of a key inflection point in some of this week's coming trade. Now, let's move on from the S&Ps, and we're going to cruise over to the SPX for just a moment. And the reason we want to look at the SPX is because, well, the expected moves. So this past week, we had right around a $32, $33 expected move. And all that is, okay, when I say a $33 expected move, again, there are a lot of new people that tune into these videos, day in and day out, week in and week out. The $33 expected move, that is the range, okay, depicted by the options market. So it says what? We're supposed to move up $33 or down $33, right? So there's a $33 expected move. We stay within that range. However, we did get extremely close to testing into the bottom of that range coming into Tuesday over there. Now, switching gears for just a moment. Let's look out, right, to this next week. What are we expecting this next week? Nearly identical volatility to the previous week. And the reason I say we're kind of switching gears, we're still talking about expected move over here, it's because we just saw a week where we came off, again, we came off lower volatility. Right? So you're thinking to yourself, all right, we just had a low volatility week. Yeah, but the expected move is actually slightly higher, okay, in this coming week. So think about that for a second. You're thinking volatility is dying down and we're going into a holiday week. but the expected move inside of the SPX, and I want to look at this directly with you, it's $33.25, albeit minimally higher than the previous week. But the interesting aspect of it is, I'm telling you, the marketplace had contracted volatility, yet this next week is showing the exact same volatility as the previous week. Clearly, the S&Ps see something. They're telling you, don't get completely off your volatility game. And that's why I keep reiterating this point, and I'll do it again and again. Reload positions, reload hedges. Use this time in this lull in volatility to kind of revamp your positions to anything you want. Okay, don't get married to positions. That means, I don't care whether you're long or short. I'm not telling you this because, I want you to be long, want to be short. Listen, there are underlyings that are going to go up in this market, and there are underlyings that are going to go down in this market. But you better be intimately comfortable with whatever your position risk happens to be. Because, again, all we're doing right now is marking time between bouts of the extreme, and that's bouts of volatility. So, again, the expected move coming into this next week is still right around 33 bucks, even though we saw volatility kind of dump down. The other aspect I really want to bring to your attention, because I have mentioned this in so many of the videos and so many times within the TheoTrade chat room throughout the course of the last few weeks, and that has everything to do with the financials. The financials, they're on the forefront of all of this volatility. They're on the forefront of whatever's going to happen in interest rates. And, I showed this again on this past Wednesday's video, and I'll kind of detail it just briefly again, because I think it's such an important point. And, sometimes those points have to be made 3-4 times. We got to drive this home to you. So you saw the financials rip to the upside, and literally the last 1, 2, 3, 4, 5, 6 trading days, you got 6 trading days where the financials started to fall off. The irony of this 6 days where the financials started to fall off, okay, as the financials were coming down, the interest rate was going straight up. And you're like, wait, isn't rising interest rates supposed to be good for financials? Yeah, but this is kind of the inflection point that we're talking about, right? Take a look at the exact same kind of 6-day window. This is bonds tanking. Usually bonds tanking is positive for the financials. Nah, it's a negative. I talked about this a couple of months ago, and I'm also going to reiterate this exact same phrase right now, and it's what I call the no way out trade. What does that even mean, no way out? That means if the interest rates take back off to the upside, right? Let's say the interest rates just all of a sudden explode back to the upside. We've hit this inflection point where higher interest rates are going to start to injure the financials. Conversely, though, if the interest rates turn around and start heading back down, that's not good for the financials either. And you start to get this no way out trade. And I think this is exactly what we're seeing in the last couple of trading sessions. That and the financials had an absolutely ridiculous and explosive rally. Again, the financials, right? This move, that's really what drove the S&Ps to these higher levels. Again, everybody seems to have their head stuck over in the Qs. Yes, the Qs had a nice move back to the upside, but on a percentage basis, the XLF absolutely smoked it. Speaking of the XLF, okay, versus the Qs, you got to take a look at this because it doesn't happen all that often. On the right-hand side of your screen, I'm highlighting it. The XLF, this is the financial ETF, right? It's almost got 17% implied volatility. All right, neither here nor there. You're like, what does that mean? It means the financials are sitting on about 17% implied volatility for the next 6 days. Now, what does the Nasdaq look like? Okay, the Nasdaq, where everybody assumes is the more volatile product. Well, yeah, but the Nasdaq, okay, has over 1% lower in terms of implied volatility, and that's why I continually say, don't get off your game. All right, the financials are actually screaming, we're ready to move again. In fact, not only are they ready to move again, but because of some of the news and information coming out this week, note that the financial volatility is higher in the 6-day window than it is in the 13-day window. All right, so we've actually seen volatility invert ever so slightly over here. Okay, and that is an important point to be made because, again, the financials, they see something. They still see risk forthcoming. Now, let's move a little bit away from general talk in the entire marketplace, right? As I kept reiterating time and again, look at your positions, be comfortable with them. Whether you're long or whether you're short, got to recognize that the marketplaces, it's going to get quiet. Traders get tired. Markets get tired. Everything, okay, is going to lead back to higher interest rates and more volatility. And at this point, you may be thinking to yourself, well, let's go take a quick look at those interest rates. I'm going to pull up the TNX. So the TNX explodes higher. But one point I also want to make with the idea of volatility, what happens if the interest rates at this point in time, well, what happens if they turn right back down? Okay. That's still going to bring repositioning and volatility to the broader marketplace, whether they go higher or lower at this point. The other aspect that we don't usually depict here on TheoTrade happens to be the short duration interest rates, looking at the 2-year and so forth. The 2-year, okay, in terms of rates, is higher than it has been at any point since all the way back down, 2008. So the impact, again, to these trading firms is huge. All right, different area I want to talk to you about here, and that has everything to do with retailers. So quick glance over at Walmart. Now, Walmart, we've been talking about this tight range and have anticipation of the range breaking to the downside. It took the earnings announcement effectively to do that. Now, in the short term, we would expect a little bit of follow through possibly to Walmart, but Walmart really is not the object of my affection here, nor is Costco, and Costco actually cracked into the 200 range. We actually had a bullish position on Costco that we pulled off profitably there. But really, when I'm getting into the retailers, I'm actually referencing more of the XRT. I think there's a great opportunity that's going to lie right here inside of the retail ETF. And that has everything to do with the fact that the retailers broke to the upside. Now, I want to show you a little bit about some of the major retailers because it's almost like a tale of two different marketplaces. You got an underlying like Macy's, and I want to zoom out. Now, this is not necessarily a liquid product, okay? It's not exactly the object of my affection over here. Nevertheless, Macy's breaks out to the upside, okay? And then we look at these one-offs, okay? And we'll pull up Nordstrom's, and we'll look at one-offs, and Nordstrom's then breaks to the downside. So this is ultimately kind of wreaking havoc inside of the retail ETF. However, I think this is a decent opportunity for those of you interested in re-upping a short position inside of the retailer. This most recent move to the upside, a little bit unprecedented, and it had to do exactly with the news earlier in the week on Macy's. Okay, then on the flip side, you can see this kind of this down day here on Friday. Well, that was the impact, obviously, of Nordstrom's and a handful of other retailers that have come out with the with earnings announcements. Nevertheless, I'll be re-upping a short position inside of the XRT kind of early in this coming trading week because I think it's nice, it's opportunistic. This is, again, a bit of a rebound trade. We're looking for a fade thereafter. Now, last but definitely not least, definitely the object of my obsession, and that has everything to do with the emerging markets. The emerging markets under serious strain here and possibly breaking under the 46 level. Now, if you're not in a position currently in the emerging markets, I wouldn't suggest necessarily getting in here and getting short. In just the next few days, few weeks, though, all I want you to do is keep an eye on emerging markets because where there's smoke, fire can actually reverberate right back to the S&Ps. And what I'm saying is the emerging markets are under a great strain. They're under a strain from what? Interest rates, but they're also under this huge strain from ultimately the dollar and the explosive move back to the upside in the dollar. Nevertheless, I would expect if the EEM starts to really crack, and I would look at the level of right around 46 as being a key threshold. Getting under 45, though, in the EEM would be dire, and not just dire for the EEM, but that contagion is going to spread to the rest of the S&Ps. I want to thank everybody for joining us here on this weekend update. Have a wonderful weekend, everybody. See you in the TheoTrade chat room throughout the course of this week. Bye-bye.